All right, welcome to today's weekend recap and look ahead video for next week. My name is Christian Fromhertz, CEO of Tribeca Trade Group, and we'll start with last week's performance and then get through and look at some of last week's activity, and then look at the technicals, and I will give you my market view as well. So first off, a really strong week for equities, of course, following the first round of the French election, and the beginning of the week was where we saw most of the performance. Nasdaq and small caps made an all-time high last week, so pretty powerful stuff, and it happened very quickly. So for the week, S&P was up 1.5%. Small caps were up about the same, 1.4. Really nice, strong outperformance in the Qs, up 2.6% last week, and then a lot of the international areas, which I know sometimes take a back seat to U.S. investors, but emerging markets were up 2%, and EFA, which I refer to as the European and Japanese SPY, was up 3%. And bonds and gold were weak, especially, again, most of that performance coming in the beginning of last week. They actually did recover a little bit from where they were in the beginning of the week. So let's just dig into, I always will look at ETF fund flows. They really give a nice barometer of what's going on in the market. And the main thing that I had been focusing on the last couple of weeks is there was absolutely no money that had been going into equities, especially, well, a little bit into international equities, but especially U.S. markets and U.S. equities. And so I made reference, I think, in last week's video to the fact that the spigots had been turned off in terms of how much money that normally goes into equity ETFs, which is roughly, about $1 to $2 billion a day that's been going into equity ETFs, especially over the last 6 months or so. But we really didn't see anything in terms of money that was going in to the equity market over the last from basically March option expiration to all the way to last week. So what did we see last week? Basically, all that money that had not been going in went in a number of in about 3 or 4 days. There was $17 billion of equity inflows last week. So really a colossal amount of money going into the market in a very short time. So that number, I'm sorry, so that was $17 billion in the US and $4.3 billion going into international. So when you add the two up, you get over $21 billion that went back into the market last week. And this is typically what we've seen in some other, when there's been other big macro events. We saw the same phenomenon go on in during or leading up to the Brexit vote as well as the US election. And really what happens is investors and funds sit on their hands when uncertainty picks up and gets higher and higher, and then all of a sudden once an event comes out, everybody feels better and they start buying again. So we see this time and time again, and so really a lot of money being redeployed. So where did that money go for the most part? Where was the 17 or $21 billion of equity inflows last week? Where was the money deployed? Well, it was mainly a grab for beta. We didn't really see too many picky areas. They were just basically going into SPY, IVV, and VOO. These are all S&P related ETFs. What's the difference between them? Since the benchmark is all the S&P, it's really the management fee. And since it's the only real difference in SPY, IVV, and VOO is the management fee. It kind of separates investors a little bit. SPY is a lot of short-term money, or it can be a lot of short-term money, considering that it does have a higher management fee. So short-term investors aren't really going to care too much about that fee, but IVV and VOO, which both have, I think I have it in here. They charge only 4 basis points to aside. So and SPY charges 9.5 basis points. So these are used by more long-only funds. Again, you really would rather go into VOO because it's cheaper. So a more longer-term investor, or at least not so short term, is going to go into something like VOO and IVV versus SPY. So that's my own personal take on that. But you could see all three of these funds. It wasn't just SPY that saw the inflows. And then if you look also on this list of the largest flows by ETF, you could see that it was also the Qs and IWM that also grabbed just a huge amount of inflows. Again, so not so much, it wasn't so much sector related. It was more just, hey, I got to get back into the market and I got to do it quickly. So if we look at sectors for the week, you could see you could kind of categorize this as riskier sectors. You even have energy in there, which energy to me looks atrocious, and we'll look at those charts in a minute. But industrials and financials also saw some decent inflows. Really, if you look down at the outflows, look at the materials, and all of this was not XLB. XLB actually saw inflows for the week, but it was really the gold miners. Bloomberg classifies the gold miners under materials. They saw some really, really large outflows last week. And again, so did gold in the beginning of the week. For the week, gold saw $217 million outflows. Again, mostly right in the beginning of the week. The gold mining ETF saw, as you can see, GDX was actually the largest outflow of any ETF last week, and so that lost over $700,000. Had $700,000 in outflows, and GDX was also listed there as well. I think this is also on the list. $283 million. So among the biggest outflows last week were in gold-related funds. In international markets, the biggest inflows into European equities. Again, they had been seeing inflows for the last couple months, which is again completely new from what we saw in 2016. First half of 2016, it was all outflows in Europe, and then we started to see that stabilize towards the end of 2016, and then we've been seeing inflows for the first couple months of 2017, and again it kind of quieted down along with the U.S. and we see a surge coming back into European and Eurozone ETFs. And it wasn't just one particular fund. There was EZU, which saw the biggest inflow, but it was also FEZ, VGK, DBEU, EUFN, IEV. So certainly it wasn't just one investor who was in there buying Europe. You could see six different ETFs saw inflows last week in Europe. And then the same story with emerging markets. This has been pretty consistent from week to week. Another $1 billion added into emerging market ETFs. Again, a little bit quiet the last couple weeks, but certainly the money has come right back in, and that's been the trend for all of 2017. A lot of money going into emerging markets. So I think that covers it. I spent a little bit more time talking about the fund flows because they were very notable last week, and I had put out a lot of statements about why the market wasn't going up in April, and just nobody was buying. Everybody was sitting on their hands. So this is just a nice conclusion about what I've been talking about the last few weeks. And typically, whenever you see the flows really quiet down in ETFs, it usually ends up being a buying opportunity, a nice contrarian buy signal, which is what we got. So I want to talk a little bit about the events for next week. Last week we had just a ton of companies reporting, so it made for a little bit. Earnings season to me is always a choppy time to trade, and it's a difficult time to position and put on new positions. I usually like to wait for how the results come out, and then I like to focus on option activity where the buyers show up after a name reports. And we start to see. I believe we'll start to see that this week. Considering, I believe we're at least 60% done with earnings. I don't have the exact number, but I believe it's somewhere around there. So next week we have another 122 companies in the S&P 500 reporting. We get Apple and Facebook, and then we also have some events to watch. We get the 2-day Fed meeting. There's no real expectations for interest rates to be hiked this Fed meeting, but I think the attention will be firmly on when they actually any guidance into when they will be possibly doing that in the next upcoming meetings. So sorry, I'm stalling while I'm trying to bring up what the Fed fund futures are implying for the next rate. It looks like only right now 70% chance of, May is 13% chance, and it is higher than I thought. It's in June, it's about a 70% chance that they're going to raise interest rates. So we'll see what kind of language comes out this week. We also have more economics that are coming out that I think are going to be important. Last week we had GDP that was pretty ugly, I would say, but GDP is always a backward-looking indicator. It's great for telling you what happened months past. This week we get the jobs data on Friday. It's the first Friday of the month, believe it or not, for May. So we'll be getting the jobs data. If you remember from the last month, it definitely the jobs data that came out was a downtick, so it was weaker than expected. Let's see if that was just a one-off scenario, as sometimes economics are, or if it's the beginning of a trend that there's a little bit of a soft patch in the economy. We don't really know that yet, I would say, because it's basically been not only with the jobs data that happened last month, but some of the other data that's been coming out, such as retail sales, durable goods were a little bit weaker. So we'll see if if the trend changes, or if we are actually facing some type of a soft patch. We also get ISM data, which is also a really nice forward-looking data point, and construction spending as well. So again, that's where I'm really interested and concerned, watching what the next couple weeks of economics will be. But if you want to look at it in terms of the silver lining, if the data does come out weak, it's going to be harder for them to raise interest rates. So it's going to be kind of a seesaw effect. It's like, hey, do you want the strong data and more interest rate increases, or would you rather be okay with a little bit softer data and possibly them not raising interest rates? So you really have to put it in that perspective. So just to kind of look at, so that's the main events for the week. I think there's also a couple meetings. I think Draghi speaks as well. I think there's a meeting between Putin and Merkel. And then once we get towards the end of the week, then we do have to revisit the French election. I think there's also a debate midweek between the two contenders over in France. So that will come to the forefront again as we get to the end of the week. But I think for the most part, in the beginning of the week, people are really going to be focused on the earnings as well, for the most part. Okay, so before I start to look at some charts, I'm going to talk about the sectors for a little bit. Last week in last week's newsletter, we talked about how the sector breadth was improving. Again, this is from last week's newsletter. We talked about consumer discretionary making a 52-week high. We talked about tech moving up. We talked about industrials moving up, and stronger than they were a couple weeks before. So that was a really good clue. If you look now, you had six sectors before that were above the 50, the 100, and the 200. Now you've got more than that. So was this 1, 2, 3, 4, 5, 6, 7, 8? That's what I thought it was. 8 sectors that are now really, really strong looking, above the 50, 100, and 200-day moving average. So this is back to where we were basically, I would say, back in March. For April, we saw breadth decline, and we saw some sectors really, there was sector deterioration going on. Now we're seeing them start to really pick up some steam, and a lot of 52-week highs last week. I believe it was, um, let's see. Tech consumer discretionary made another 52-week high last week. Materials also made a 52-week high, XLB, on Wednesday. So is it time to really, party and say, the bulls have won? No, not necessarily. I think if you're in some of these areas, that's great. You made some profits. What to kind of focus on next? Take a look at, financials are still in this neutral area. I know there's so much, financials get so much attention in the financial media, but I think you really I don't have them listed as avoid. I have them listed as neutral, but I'm really waiting for them to, if we go to the chart of XLF, which I said I was going to mention, I don't think you want to jump into them here. I am waiting for some confirmation. So they're right around the 150-day moving average. Either they fail here and move back down, or they break out. So I would really be, I'm watching this very closely to see if XLF gets back above the 50-day moving average. Then I think it becomes more interesting, and then we could start to look at some individual names. For now, I would rather focus on, and it's why I do this analysis every week, is because if something is exhibiting strength, then I want to look for longs in the strongest sectors, and I really want to avoid the weakest ones. Hence, energy you see in the red there. I really don't want to be in energy names right now. They look pretty ugly. If you look at the chart of XLE, let me just go back to XLF and type in XLE. A lot of ugly things here. I see, first of all, we failed at the 200-day moving average. We try to reclaim it. We got above it for about a week or so, and then we failed, and we have been going lower here. The trend looks lower to me. I also see the 50-day moving average crossing below. First, it crossed below the 100, then it crossed below the 200. That's a death cross. That's not a positive. So that's a bearish signal, and I think it's hands off until it reclaims the 50-day, at least the 50-day moving. Excuse me, not the 50, the yellow line, the 200-day moving average. And it's the same thing. I can look at individual names, but I'd rather just stick with the ETFs here because they're going to tell you the trend. OH really, this was the strongest of the three ETFs that I look at in energy for a couple weeks, and now this has really been moving down to the downside pretty quickly here. XOP, which is the equally weighted oil and gas drillers and explorers, that's also about the same. That's actually holding up a little bit better than XLE and OH, but again, no reason to even try to get involved in this until, for me anyway, until it gets back above the 200-day moving average. So, anything other than that is just purely speculation and not going with the trend at all. So, I really I'm avoiding these names. I was in a couple energy names. I was in Halliburton. You know, thank goodness for that my trading system again is much more important than my picks. I said I will try a long here at the 200-day moving average in Halliburton, and if it breaks the 200-day, I'm right back out. So I gave this a shot. Looked like it was starting to build, and then it broke below the 200. I got out right away, and good thing I did because it looks like it's gone down further here. I'm in one other name, which is right around the 200-day moving average, and I'm waiting to get stopped out. But I'll wait until it actually my trading system tells me that the stop is hit before I actually get out of it, even though I think they go lower. So I'll let my trading system make the picks for me rather than me doing the speculation. So is this a concern? I see this a lot in the financial media. They'll talk about, wow, the energy stocks, wow, they're really weak. So the takeaway from that is don't belong any of the energy stocks. They're not a big weight in the S&P or the Russell small caps. I've seen people misquote this before. They talk about, oh wow, the Russell's weak today because energy stocks. Energy stocks are not a big weight in the Russell small caps, the IWM. They're less than a 3% weight. So if you hear that from somebody, that's incorrect. The financials are a big weight in the small caps, not energy stocks. Also, just looking at the weight in the S&P, it's 7%. So it's a little bit. They do have more than a 2 or 3% weight in the S&P, so they are going to affect them a little bit. But they're certainly not as big of a weight as something like technology, healthcare, or consumer discretionary, which are all double digits weight in the S&P. So again, it might be a little bit impactful considering that they're a 7% weight in the S&P, but I just think you'd rather just don't be in energy stocks while they're in a downtrend. Wait for some confirmation for them to get above the 200-day moving average. So that is what I think in terms of sectors. Other things that I look at to kind of give me, besides price, which price is your ultimate indicator, which I'm going to talk about those charts briefly, and then we'll talk about some other indicators that I look at. The S&P, really what I'm watching for is it did not make a 52-week high last week, which was really close. I would be watching for, we're going to be in the new value area of of May, which I can't believe we're going to be in May already. But so really your support, which was right up here, is what I was looking at. For the new month, it's going to be 236.04. So if we see a pullback into this support, I think it will be a great place to buy. That this is also the 50-day moving average, which we were underneath for about a week. Maybe we do get a move back here to the 50-day moving average, and I would definitely be a buyer there if that does take place. We'll talk about IWM next, and from something being out of the three major U.S. indices that I look at, the S&P, SPY, the Qs, Nasdaq, and small caps. The small caps were really the weakest for a couple weeks in there and barely hanging on. They were below the 100-day moving average, which I don't have drawn on this chart. And then really what we've seen the last couple of weeks is some nice outperformance by the small caps. Not so much on Friday, but definitely the last 2 weeks we've seen the small caps outperform, which is a pretty good sign. Again, 137.42 is going to be your support for May. So if we do get a pushback to that, I would be definitely a buyer. As long as we remain above this level and as long as we remain above the 50-day moving average. So, I don't necessarily think that we're going to get, again, I don't have a crystal ball regarding a pullback right away, but I'm just saying I think there's good support there. And I think if we get a little bit of volatility in the beginning of the week, which again wouldn't surprise me considering that we still have a lot of events that both macro and micro in terms of earnings. So if we do get some type of a pullback, I think it would be great to you have some great spots to add to some longs. Qs continue just to have the strength in this market. Very, very bullish looking. Prices, way above the short-term moving averages. And for this one, I'm going to say something stupid, which you hear all the time, but the trend is your friend until the trend is until the uptrend is not there anymore. So I think you want to stick with this. Of course, we have Apple reporting next week. Apple really wasn't one. It is the biggest weight in the Qs and in S&P, but it really wasn't the big performer last week. So heading into this earnings, I think it's nice. It's that we haven't run so much as what Google did, as well as a couple other companies like Microsoft really ran into their earnings report. So I was a little bit concerned. I did not go long. I have no problem telling you what I did and what I didn't do, but I thought Google ran a little bit too much into their earnings report. So I kind of sat on the sidelines with this one and didn't put any long positions on in Google. And you could see that I was wrong with this one. I thought, hey, this thing is looked a little bit toppy to me, but we got a huge gap up in this one. Same thing with Microsoft in terms of running up. It actually did okay. It actually finished up on the day on Friday, considering that it started the day lower. But I did not play Microsoft because I thought it had run too much into the report. So then if you look at Apple, which again, each one of these is completely independent of the other one, but the thing that I can tell you that's for sure is that Apple is in an uptrend. So I will probably be looking to play this to the long side. Facebook also reports next week. Again, I feel a little bit apprehensive in terms of playing Facebook considering the run that it's had. So I may just sit on the sidelines in Facebook considering it had that gap up following the Google earnings. So those are the two big names that are reporting. Like I said, we also get a number of other names which we'll be reviewing in the Tribeca trading room every day next week as we get into those names. Other indicators to look at next week, and then I'm going to go into a couple other areas of the market that I'm watching. But we talked about already the probability of a rate hike. A couple other things that I like to look at is iron ore futures. Just some things that have been really moving a lot. And I'll just switch this. So I've got candles, but this did break. This was about a 30% move from high to low. So it has been hanging in there a little bit. So I would watch this 200-day moving average in iron ore futures. We'll see if we can get back above here. It almost looks like a little bit of a W pattern forming, but again, I'm speculating. And first, we'll see if we can get above that 200-day moving average. Also, I like to look at the Baltic Dry Index because that's a good, real good proxy for economic activity. It has been coming a little bit off the highs here. Still not down really that much. I don't think a cause for concern. And it looks like it's hitting that 50-day moving average, so maybe we'll find some support here. But again, pretty strong looking here in iron ore. We talked about energy names already. Certainly with oil, oil has been chopping around. Let's see if it can hold this bottom price range down here. Again, below the 200-day moving average is the main thing that I see here. Copper is something else that I like to look at, and it actually had a nice week last week. It is running a little bit into resistance here, the 50-day moving average, but it's still above the 200 and definitely did not break down here, which it looks like it was close to doing about, 2 weeks ago was it? So it has been moving up. It's not the fastest moving commodity right now, but it's still nice gains. I'm not going to complain about this at all. Last 2 weeks have been strong. We'll look at bonds and we'll look at silver as well. Bonds have really been kind of hanging in there. I mentioned in the beginning of the week, they sold off pretty hard. They actually held up for the rest of the week, and this is the sideways pattern or sideways range that we have been talking about for months, where we broke out, still underneath the 200-day moving average, but we broke out and we're actually hanging above it here. So, I don't think, it is, again, it's under the 200-day moving average, which I don't really like, but I think from a diversification standpoint, not the worst thing in the world to have a little bit of bonds. And what I like better here is gold because it's above the 200-day moving average. So I did actually start a position in gold, both in cash and in a option call spread last week. Because I think this is pretty simple here. It's a break above the 200-day moving average, this white line, a retest, and it's holding. So the retest is holding. So I don't know what's going to happen here. Again, I don't have a crystal ball, but I think it makes for a nice, easy setup. I went long here and hoping that it will hold the 200-day moving average, and we'll see what happens. If it breaks below the 200-day moving average, I'll get out really quick for a small loser. So I would rather have, and again, why I like this setup is it's just above resistance. Excuse me, it's just above support, and if it falls right below support, I can get out really quickly. So and I think also for my portfolio, really a good good diversification. At this point, I'm looking for things that don't have a high correlation with a lot of my other cash and option positions. So I think this is a good shot here to take versus some really nice defined support. So that's a lot of the macro indicators that I look at. What I'm also looking at is biotech. I see, I will look at a short-term high and low list at least every couple of days. And what I've noticed is some of the health pockets of healthcare are showing some strength. I talked about this. I think it was either last week or in 2 weeks ago, the video where I was talking about a lot of the medical device companies were showing some strength. And there is an ETF, it's the IHI. It found some nice support at the 50-day moving average, and then has moved higher with a couple names that reported last week. But a lot of the individual names started to show some signs of life in the last couple of weeks as I started to see some short-term highs, new highs taking place in the medical device equipment area. So I'm also seeing some names in the biotech space also show some strength, which Vertex has been strong for a couple months now, but I'm also seeing just more names that are showing some recent highs. So both larger, a few larger biotech names, but a lot of smaller ones that are doing it as well. So this is going to be and for the last year, it's been a challenging sector. So you really want to be careful about how you're putting on positions, if they're options or if they're in cash. You want to really, as with anything, establish your stops on entry. But healthcare and biotech have been basically a couple steps up and a step back. So it's been pretty choppy, but you could see if you're patient with this, if you've been patient with this trade, the break of the 50-day, the 200-day moving average has been some good buy signals here. Again, it moves up and then it retests, so it doesn't get too far from the moving averages. The moving averages are sloping; all three of them are sloping up a little bit, but they're not going much higher. So I think it's worth taking a shot at biotech here. I will probably start a very small position next week because I hear there's more chatter about the Republicans trying again to repeal and replace. So the reason why I'm starting a small position is because you know the biotechs do move on the biotech stocks do move on these headlines, so it would be a good place I think to maybe start a position while the price is above the 50-day moving average, and then if there's a little bit of a retest of support, then you could put on a larger position, which is what I will be looking to do. So that's one area of the market that I'm looking at. Also, an international area of the market. Now we know Europe has been breaking out. I don't really want to add because I'm already long Fez, and I really just haven't touched that. I'm following my trading system and really not touching that too much. So I don't really want to add to any European names going into this second election, but I'm going to stay the course like I've been doing. But one area of the market where I think is intriguing is some of the Latin American areas that have really been breaking out. You got a nice retest. So ECH, this is a name to play in cash, not in options. And it's got a nice pullback to the 50-day moving average. So I'm looking for confirmation to see if the 50-day moving average holds, and I'll be looking for a long in the Chile ETF. And then another ETF that I think is probably new for many of you. This is something that I've been watching as it's been breaking out. This is called the MSCI. Oops, that's not the right name. I have to correct that. XT is the exponential technology ETF, not the emerging markets ETF. So let me just go ahead and fix that in my newsletter. But so you look at the components of this name, and first of all, the price has just been astounding, right? It's kind of like the robotics ETF that we've been talking about, how the trend has been, the names have really been in a nice trend. But this is another one. This is the exponential technology ETFs. Look at the names that are in here. First of all, it holds a lot of non-U.S. companies. So if you're looking for a little bit of diversification, getting away from the U.S., 43% of the ETF is in international names. Some of the U.S. top weights in the ETF, you could see it's kind of a mix of going back to biotech and a lot of technology. I see a lot of semi names, and I see a lot of other technology names that are in this ETF, and the performance has been astounding. So this is a name I don't think that, or this is an ETF that I'm not looking to get involved right away. I'm looking for a retest back to the 50-day moving average. Definitely on my radar. And the last chart that I'll leave you with, speaking of the robotics ETF, this is something that we've been all over with. We did a webinar the last couple weeks. Also a new 52-week high last week. This is a core position for me. So I'm going to continue to watch this one. The 50-day moving average is something that, as it's starting to get elevated now above the 100-day, is something that I'll be watching. But again, I want to remain long this as long as this is in a nice uptrend. So thanks very much for watching this week's video, and have a great week. I know this has been a long video, but please do get involved. If you haven't checked this out before, TribecaTradeGroup.com. Get involved, and if you like this analysis and if you like this video, this is what we do all day long, every day in our live training room and chat room. We post analysis after hours as well as, of course, during the day. In terms of the trading setups that I'm looking at. So TribecaTradeGroup.com. Again, I don't really change this around too much, but the coupon code is TTG. You get half off the first month. It's worth your while to check out. Thanks for watching the video, and enjoy the rest of your weekend.